What if I told you there are 3 stocks right now with the potential to transform your portfolio? In today's volatile market, these are the opportunities savvy investors are searching for. These aren't random picks. Each company has a unique edge, and analysts are bullish. We'll cover a biotech innovator tackling a massive health crisis, a leader in genetic medicine, and a consumer goods giant quietly delivering value. I'll break down what makes each company special, why experts are excited, and how you can get in before the crowd. The last stock is a hidden gem almost nobody is talking about. Don't miss it. Hit like, share your thoughts in the comments, and subscribe for more investing insights. Let's dive into our first pick, 𝗗𝗟𝗨𝗦 Therapeutics, ticker symbol MLYS. This is a company that's quietly making waves in the healthcare sector, and it's one that many investors are still sleeping on. But if you look closer, you'll see why it's starting to attract serious attention from Wall Street and beyond. 𝗗𝗟𝗨𝗦 is targeting a huge underserved market, hypertension, a chronic condition that's often called the silent killer, because it can go unnoticed for years while causing serious damage to the body. Hypertension affects nearly half of U.S. adults, which translates to over 120 million people. That's a staggering number, and it's not just a statistic. It's a real daily struggle for millions of families. What's even more concerning is that many of these patients don't respond to current treatments. Despite the wide range of medications available, a significant portion of people with high blood pressure still can't get it under control, leaving them at risk for heart attacks, strokes, and other life-threatening complications. That's where 𝗗𝗟𝗨𝗦 steps in. Their lead drug, lorundrostat, is a selective aldosterone synthase inhibitor, a mouthful, but a truly innovative approach in the world of hypertension treatment. In simple terms, lorundrostat targets the root cause of high blood pressure for many patients, not just the symptoms. By blocking the production of aldosterone, a hormone that can drive blood pressure up, this drug offers hope to those who haven't found relief with standard therapies. The market potential here is absolutely massive. If lorundrostat succeeds, we're talking about a multi-billion-dollar opportunity. Hypertension is a global epidemic, and a new effective treatment could quickly become the new standard of care. 𝗗𝗟𝗨𝗦 has already delivered strong Phase 2 trial results, which is no small feat in the world of biotech. These results have caught the eye of both clinicians and investors alike. The data showed significant blood pressure reduction in patients with resistant hypertension, those who have tried multiple drugs without success. That's a game-changing result for a population that's often left with few options. This isn't just an incremental improvement, it's a potential paradigm shift. Major analysts are taking notice and are increasingly bullish on the company's prospects. For example, Bank of America has issued a buy rating and set a $26 price target, reflecting their confidence in both the science and the business model. Meanwhile, Guggenheim is even more optimistic, projecting the stock could reach as high as $50 if things go right. That's a potential double or more from current levels. The key catalyst on the horizon? Results from their ongoing Phase 3 trials. This is the make-or-break moment for any biotech, and all eyes are on the data. If the results are positive, the stock could absolutely soar, rewarding early investors who saw the potential before the crowd. Financially, 𝗗𝗟𝗨𝗦 is in a strong position. After a successful IPO, the company is well-funded with enough capital to see its clinical programs through to completion. This financial runway is crucial in biotech, where running out of cash can halt even the most promising projects. 𝗗𝗟𝗨𝗦 has planned carefully, ensuring they can execute on their vision. The management team is another major asset. With deep experience in cardiovascular drug development and commercialization, they know what it takes to bring a new therapy to market and navigate the regulatory landscape. Of course, there are risks. As with any biotech, clinical trial failure is always a possibility, and the competitive landscape is fierce, with other companies racing to develop new hypertension treatments. But lorundrostat's highly targeted approach, focusing on aldosterone synthase, gives it a strong scientific edge over more generic therapies. This specificity could translate to better outcomes and fewer side effects. The next 12-24 months are absolutely critical. Investors should watch for trial updates, but also keep an eye out for potential buyout interest from Big Pharma, which is always on the hunt for innovative pipeline assets. If Phase 3 is successful, 𝗗𝗟𝗨𝗦 could become a prime acquisition target, likely at a significant premium to its current valuation. Big players may want to snap up this breakthrough before it becomes mainstream. To recap, 𝗗𝗟𝗨𝗦 is addressing a huge unmet need with a promising differentiated drug. The science is robust, and the company is positioned to make a real impact in the lives of millions. Early clinical data is strong, and major analysts are lining up in support, which is always a good sign for investors looking for validation. The risk is real, as with any early-stage biotech, but the potential reward is a true multi-bagger, an investment that could multiply several times over if things go right. For investors with a higher risk tolerance and a long-term outlook, this is a name to watch closely. The upside is significant, but patience and due diligence are key. As always, do your own research. dig into the data, and consult with a financial advisor if needed. But don't ignore the potential here. Opportunities like this don't come around every day. This is the kind of high-impact opportunity that can supercharge a portfolio, especially if you catch it before the broader market catches on. The science is sound, the market is huge, and the upside is hard to ignore. 𝗗𝗓𝗏 is at the intersection of innovation and unmet medical need. If you're looking for a biotech with real breakout potential, 𝗗𝗓𝗏 Therapeutics should be on your radar. It's a story that's just beginning to unfold. Remember, in biotech, timing is everything. Getting in before the market fully appreciates the story can make all the difference. The next big catalyst could be just around the corner, and those who are prepared stand to benefit the most. Keep an eye on those Phase 3 results. They could be the turning point that propels 𝗗𝗓𝗏 into the biotech spotlight. This could be the start of something huge, not just for the company but for patients and investors alike. Don't sleep on this one. Opportunities like this are rare, and the window to act may not stay open for long. 𝗗𝗓𝗏 could very well be the healthcare breakout of the year, setting a new standard for innovation in the space. Let's move to our next explosive opportunity and see what else the future of healthcare investing has in store. Our second stock pick is BridgeBio Pharma, ticker BBIO, a true biotech powerhouse that's making waves in the industry with its innovative approach and ambitious vision. BridgeBio isn't just another biotech company, it's a leader with a unique, diversified model that sets it apart from the competition and positions it for long-term success. What makes BridgeBio so compelling is its structure. The company operates almost like a biotech holding company, developing a broad portfolio of therapies for a wide range of genetic diseases. This means they're not putting all their eggs in one basket. By spreading risk across multiple programs, BridgeBio multiplies its chances for success and creates a steady stream of opportunities for breakthroughs. At the heart of BridgeBio's current momentum is their lead drug, 𝗗𝗓𝗦𝗧. This therapy is designed to treat ATRCM, a rare and serious heart disease that currently has very limited treatment options. For patients suffering from this condition, 𝗗𝗓𝗦𝗧 could be a game-changer, offering hope where there was little before. Recently, 𝗗𝗓𝗦𝗧 delivered outstanding Phase 3 clinical trial results meeting all primary and secondary endpoints. This is a huge milestone as it not only validates the science behind the drug, but also positions BridgeBio for what could be a blockbuster launch. The excitement in the scientific community is palpable and investors are taking notice. The FDA has recognized the potential impact of 𝗗𝗓𝗦𝗧 by granting it priority review status. This accelerates the review process, with a final decision expected by November 29, 2024. That's a major near-term catalyst that could send shockwaves through the biotech sector if approval comes through. Wall Street is already buzzing. Top analysts are extremely bullish on BridgeBio's prospects. JP Morgan has set a $42 price target, while Goldman Sachs is even more optimistic at $45. Both firms highlight 𝗗𝗓𝗦𝗧's best-in-class potential and the company's robust, diversified pipeline as key reasons for their confidence. But BridgeBio isn't a one-trick pony. Beyond 𝗗𝗓𝗦𝗧, the company boasts a pipeline of over a dozen other programs in various stages of development. These range from treatments for hormonal disorders to therapies targeting genetically driven cancers, rare pediatric diseases, and more. This breadth gives BridgeBio multiple shots on goal and ensures that its growth story doesn't hinge on a single product. The depth and diversity of BridgeBio's pipeline mean that the company is well-positioned for sustained, long-term growth. Each program represents a potential revenue stream, and as more candidates advance through clinical trials, the company's value proposition only gets stronger. Leadership is another key strength. BridgeBio's management team, led by founder and CEO Neil Kumar, has a proven track record of successfully advancing drugs from concept to market and raising the capital needed to fuel innovation. Their experience and vision have been instrumental in building the company's reputation as a biotech innovator. Financially, BridgeBio is in a strong position. The company has raised significant capital to support the upcoming 𝗗𝗓𝗦𝗧 launch and to continue investing in its R&D pipeline. This financial flexibility is crucial in the biotech world, where the path from discovery to commercialization can be long and expensive. Of course, there are risks. FDA rejection is always a possibility in biotech, and regulatory hurdles can be unpredictable. However, the strength of the Phase 3 data for 𝗗𝗓𝗦𝗧 gives BridgeBio a solid foundation for optimism. Commercial execution is another challenge. BridgeBio will be going up against established competitors like Pfizer, who already have a presence in the ATTR-CM market. Success will depend on the company's ability to differentiate 𝗗𝗓𝗦𝗧 and effectively reach both doctors and patients. Still, 𝗗𝗓𝗦𝗧's superior clinical profile and the company's focus on patient outcomes could give BridgeBio a real edge in the marketplace. If they execute well, they could quickly capture significant market share. If approved, 𝗗𝗓𝗦𝗧 is projected to generate between $2 and $4 billion in annual sales. That kind of revenue would not only fund further pipeline growth, but also transform BridgeBio into a major player in the biotech industry almost overnight. Despite all this potential, the market hasn't fully priced in BridgeBio's transformation from a research-focused company to a commercial powerhouse. There's a real opportunity here for investors who can see the bigger picture. An FDA approval in November could be the spark that triggers a major re-rating of the stock, sending shares sharply higher as the market catches up to the company's new reality. This is more than just a short-term trade. BridgeBio represents a long-term growth story that's only just beginning. For those with patience and vision, the rewards could be substantial. For investors, this is a rare chance to get in before a company transitions from years of R&D spending to sustainable profitability. The inflection point is here, and the risk-reward profile is highly attractive. With the risk now lower thanks to strong clinical data, but the upside still huge, BridgeBio offers a compelling opportunity for those willing to act before the crowd. To sum up, BridgeBio is a biotech innovator with a blockbuster drug on the verge of approval, a deep and diverse pipeline, and strong support from top analysts. The company is poised for a breakout moment. The next 6 to 12 months could be truly transformative for BridgeBio and its shareholders. Key milestones are on the horizon, and each one could unlock significant value. If you're looking for exposure to a biotech company with both near-term catalysts and long-term growth potential, BridgeBio absolutely deserves a spot on your watch list. Don't wait for the market to catch up. Position yourself now, while the story is still unfolding and the biggest gains are yet to come. This is the kind of inflection point where fortunes are made, and where early investors can reap the rewards of vision and conviction. BridgeBio is ready to break out and redefine what's possible in biotech. Keep this one on your radar, and don't let this opportunity pass you by. Now let's shift gears to a different kind of opportunity, one that offers a blend of growth and stability for your portfolio. Here's a stock for those who want growth with stability and a chance to build wealth over the long term. Our third pick is Post Holdings, ticker Post, a consumer goods giant that's quietly built an empire while flying under the radar of most investors. While it may not have the flash of a tech unicorn, Post's story is one of steady growth, smart strategy, and resilience. Post is far more than just a cereal company. It's a diversified powerhouse, with a portfolio that stretches across breakfast cereals, pet food, refrigerated foods, and food service. From Fruity Pebbles to value-added eggs, Post's brands are woven into the fabric of daily life for millions. In today's uncertain economy, consumers are increasingly seeking value and reliability. Trusted brands matter more than ever, and Post delivers both, offering products that families return to week after week, year after year. Their products are true staples, found in pantries and refrigerators across the country. This everyday presence makes Post's business model incredibly resilient, able to weather economic storms and changing consumer habits. While high-flying tech stocks can swing wildly from quarter to quarter, Post generates consistent, reliable cash flow. Its business thrives on stability, making it a safe harbor for investors seeking less volatility. But don't mistake stability for stagnation. Post is a master of smart, strategic acquisitions, constantly expanding into high-growth areas like pet food and value-added eggs. These moves have transformed the company from a cereal maker into a diversified food leader. The acquisition of Michael Foods brought a leading egg and refrigerated foods business into the fold, while adding pet brands like Rachael Ray Nutrish has opened up new, fast-growing revenue streams. This diversification is a key reason Post is positioned for future growth. It's this blend of stable, legacy brands and new growth drivers that gives Post its unique edge. The company isn't just resting on its laurels, it's actively building for the future. Despite these strengths, the stock trades at a cheap valuation, well below its peers in the consumer goods sector. This disconnect between price and fundamentals creates a compelling opportunity for value-focused investors. Wall Street is starting to take notice. Stifel has set a $115 price target, and Evercore ISI is even more bullish at $120. Both firms cite Post's undervaluation and strong execution as reasons for their optimism. Post isn't just sitting on its hands, the company is aggressively paying down debt, strengthening its balance sheet, and buying back shares. These moves directly boost shareholder value and signal management's confidence in the business. Of course, there are risks. Shifts in consumer preferences or rising input costs could impact margins. But Post's broad brand portfolio and diversified product lines help cushion against these headwinds, making it more adaptable than many competitors. The company's focus on deleveraging and returning capital to shareholders is a powerful catalyst for a higher stock price. As debt falls and buybacks continue, the value proposition only gets stronger. This is classic value investing in action, a high-quality, cash-generating business trading at a discount to its intrinsic worth. For patient investors, these are the kinds of opportunities that can quietly compound wealth over time. If you're looking for a smart anchor for your portfolio, something that offers stability, reliable cash flow, and real upside, Post fits the bill perfectly. It may not deliver the explosive returns of a biotech moonshot, but it offers solid, market-beating performance with far less risk. Sometimes, slow and steady really does win the race. Don't overlook this so-called boring stock. Often the best opportunities are hiding in plain sight, quietly compounding value while others chase the next big thing. Post is a true cash flow machine, powered by a collection of fantastic brands that consumers trust and buy every day. The market is mispricing this one, but that won't last forever. As more investors catch on, the gap between price and value is likely to close. This is your chance to get in before the crowd. Buying quality at a discount is how long-term wealth is built. For a blend of defense and offense, Post is a layup, an easy win for investors who want both protection and potential. Add it to your watch list, do your research, and consider how it fits into your broader investment strategy. Sometimes the best investments are the ones everyone else ignores, until it's too late. Post Holdings is ready for its next chapter, with a strong foundation and a clear path to growth. Don't miss out on this value play. Opportunities like this don't come around every day. Now let's talk about your next move as an investor. Are you ready to take advantage of this overlooked gem? Here's how you can take action today, because sometimes the smartest move is to invest in what everyone else is missing. There you have it, 3 stocks with massive growth potential: 𝗗𝗟𝗏𝗧, 𝗗𝗏𝗏𝗏, and Post Holdings. Each offers a unique opportunity, from high-risk biotech to stable consumer goods. The key is finding asymmetric bets where the reward far outweighs the risk. Want to level up your investing? Check out my Value Stocks Investing Master Course, link in the description. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon community. Now, which of these 3 stocks best fits your investing style? Let me know in the comments. Don't forget to like, subscribe, and share for more top investing ideas. Thanks for watching. See you in the next one.